It is my pleasure to introduce the esteemed panel for today's discussion. This session will be moderated by N. Srinivasan. So please take your seat. Uh, and I'd like to request the panelists to come up on stage. Geeta Goel, Country Director, Michael and Susan Dill Foundation. A round of applause for all the panelists. Suman Saurav, Managing Director and Chief Executive Officer, Utkarsh Core Invest. And Shilpa Rao, Head, Gender and Finance, Swarnari Program, Reserve Bank Innovation Hub. Please give them a round of applause. Thank you all. We look forward to a very engaging and insightful discussion. With that, I now hand over the session to N. Srinivasan. Over to you, sir. Thank you.
Thank you. I think, let me first recognize the few of you who are here. The session starts late. It's also in some way reflective of the fact that small finance banks were a very late intervention in the financial sector. Before I go into the content of the session, anecdotally, I wanted to recall, we had, I think, sometime around 2013, 14, around that time, a one-day-long session in CAB. This was on the need for an alternative small finance institution. There were about about 15 of us, some from microfinance, some from voluntary sector. I think I remember Mr. Brijmohan probably was there, Mr. Nanda was also there. We were discussing all this, so the entire day went through. It was actually arranged by Access, this discussion, as part of its normal lobbying, knowledge management exercise. One of the deputy governors of RBI happened to be there that day in CAB. So the then principal, he said that, look, Mr. So-and-so DG is there. Since this is a subject that connects to the financial sector and he happens to be the appropriate person, why don't you have an interaction? He said, fine. When we were about winding up, so the last half an hour he came in. Then we talked to him about 15 minutes on what we have discussed during the day, establishing why we require a new avatar in a new form. He took about 3 minutes to say that, look, public sector banks are doing everything that you are thinking about. These are all being attended to. Priority sector norms do it. And you are wasting your time. He demolished the whole thing in about 3 minutes. I told him, since you are DG, we totally agree with what you say. He got provoked. Srinivasan, what do you mean, since you are DG? I said, sir, otherwise there will be a debate over a couple of days. Because whatever you say may not be acceptable to lot of us in the sector. So so you later on send something in writing, let me see, and then matter ended there. But then, when a new governor took over, subsequently, within a day the situation changed. Of course, I should not embrace the former DG who is sitting here. He would probably know how that changed. And then small finance banks, the regulations drafts were framed and then let out into the sector and all that. I'm sorry that anecdotally I'm traveling back in history, but then it's nice to know that some very good ideas may not find acceptance because they are good, but some bad ideas, they might get accepted because they are convenient. So this is something we should know. So turning into this, the small finance banks, I think RBI introduced it as a new class of banks to focus on some specific sectors, which most of us would like to call underserved, sometimes unserved. How to ensure that they get viable access to financial services that are comparable to the best in class. Not that there were no other institutions serving this class at that time. We had the SHG bank linkage program providing thrift and credit services. We had the MFIs serving a large number of clients. But then RBI thought there should be a way to bring this under greater regulation if it is possible by providing a pathway for the larger MFIs to transit it to banks so that the regulation that's more appropriate for banks can be applied on them and enabling them to expand on what they do, not just deepening but also broadening. So apart from credit, a range of products could be given in a deepening exercise with a bigger might of being called a bank and the ability to attract deposits. They can widen their spread. So today we have what 11 small finance banks, with one getting attached to somebody else and then undergoing the process of merger and all that. So I looked up the report to see what Ramesh had written in terms of numbers. We have about, say, roughly 2.5 trillion in deposits, 2.2 trillion in advances, which is around, say, 26 to 30% growth over a period of their existence by now. But the most significant number I saw was the net NPA was only 0.78%. You look at comparable figures for microfinance sector, they are closer to 1.5, 1.6. Am I right, Gigi? Less than 2, but more than 1. So it seems that they have done some significant business. They seem to have arrived as an institutional intervention. But the original objective, that they will foster financial inclusion, that they will probably include many more of underserved clients into fully served clients, unserved clients into served clients, and try and see whether as a bank customer they graduate from being a subsistence borrower to something better. So this is where we are. In this session we will try and then focus on is this taking place? Is the logic of bringing these institutions into existence, is it validated today? And what else that could be done? Here I have a very diverse range of interests being represented on this panel. There is a core impact investor and a hardcore philanthropist. Geeta Goyal comes from MSDF. Then we have got Sumen, owner of Utkarsh Small Finance Bank. He represents the holding company. He is the CEO there. And we have an innovator there, and from the RBI Innovation Hub, Shilpa. So this is the panel. Unfortunately, I think Mr. Bhaskar Babu could not make it today. Otherwise, there would have been more tougher questions for him to particular answer. So we are going to make it very conversational. After the first round, first question is answered by them. Feel free to raise questions from there. We will take them on directly. If you don't ask, I will ask the second question, and till such time we exhaust our list, right? I'll start with you, Sumen, because you are the, what do you call, person who actually represents the SFB here. Do you think the original objective, why these banks came into existence, is it actually being served? Do we justify that? From your own journey in Utkarsh, how do you see that?
Probably I'll start with a simple answer of saying yes. We are very much that we know the journey that we have started. We are on the very path to advance the financial inclusion. So some of the numbers that sir has already mentioned, I'll just like to reiterate those numbers. These are very broad level numbers. And this is something that, before specifically talking from Utkar's perspective, I'll talk from the entire SFB ecosystem. So the the lending portfolio that has been being cumulatively served by all the SFBs is more than 260,000 crores. The deposits that has been mobilized by these SFBs is more than 275,000 crores. And the number of physical branches that we operate through is more than 8,000 branches. And out of those 8,000 branches, roughly or little more than 20% of them are URCs, which is unbanked rural centers, which means that we have the presence uh, where actually we have been required. So the first set of data, which is basically the numbers of the deposits and the loans, it talks about the breadth of our intervention, how wide we could have reached. And at the same time, when we talk about URCs, it also talks about the depth, that the intervention, our intervention, how deeply we could penetrate to the target area, to the area where we were required to serve. So these data itself is evident of that, what we have started, or the idea with which we have been started, or the RBI, while issuing these licenses, issuing these guidelines, when they identified us as the ambassador of nurturing the cause of financial inclusion, I think we have reasonably succeeded or achieved that. Mm, you know, One more thing I would like to highlight, though we have a very stringent requirement of like 75% PSL despite turning into or getting a banking license, um, I would still say that most of these SFBs are net seller of PSLs, which means that there has not been the mission drift. We have always stayed true to the mission, to the core DNA of serving the underserved, and that's why despite that higher benchmark of 75% PSL, we are still a net seller of PSL, which means that even if the requirement was not there, or even if the requirement is less, we are still achieving on those lines. So with these, some of the data points, I would like to say that we think that we are right on the path.
Yeah, thank you. So when you're saying the large numbers that are there and the fact that you are continuing to meet the regulatory needs plus the branching out into those unbanked rural centers where there is a severe, what do you call, shortfall in banking financial services. They all testify to the fact that SFBs are in fact. Um, okay, I turn to Geeta now. You see, when you become a bank, you became a bank because you want to diversify your product, your services. But then your original clientele is what someone actually explained. So when you transit from being a very closely bottom of the pyramid kind of customer, focused on them, to becoming a bank, whether the incremental efforts you make will not take you away, whether you still are on the job of meeting the original objectives.
Yeah, so I mean, I would agree with Suman that most SFBs have, have stayed true to their original objectives, and they have served the client base that they were intended to serve. I guess, my subparts are, if they had stayed NBFCs, would they have achieved this much growth and this much widespread penetration? Possibly, yes, if they had shown the commercial viability and the investors had supported them, I would say likely. I mean, I would like to put it that these are strong institutions. The second question is that as a bank, as you start getting your own funds and therefore you attract deposits, it is from a different customer segment. So it definitely pulls you in a different direction. Which at the end of the day makes the institution stronger, because now you're not dependent on a few investors, you have a large deposit base, all of that. Which also means, your team's effort, your technology, your compliances, all of that is I'm trying to find a better word than distraction, but it does take you away from the borrowers that you were lending to. So yes, we've created a much larger spread, but there has been some distraction. And in that distraction, the small finance banks are obviously not as equipped or as capable or as advanced as the universal banks that have been existing for years. So there has been a significant investment, which, when you look at it from a market perspective, then I do feel like these banks have higher PSL norms, higher requirements from the regulator side, and they need to collect their own deposits and be financially viable, and be up to the mark on technology. So significant investment, small period of time to make it possible, but no other support or concession from the government, or anybody else to make that journey faster. So yes, they've stayed true to the mission. They've established longer term better institutions, but in the short to medium term, there are pain points that each of them are addressing in their own way.
I really like the way you summed up the last part of it. Yeah, they are at the mission, but there are pain points, and how painful we'll probably examine it a little bit. Shilpa, coming to you, you are not an insider, either as an investor or a person who is running a bank. As an outsider, how do you see? You see, when I'm an MFI, I deal with the clients. No more than that. At best, I deal with people who have to provide me either equity or bulk funds. As a bank, you have to chase deposits. And deposits, they may not necessarily come from the same customers to whom you have been lending in the past. The increased load of raising liabilities to fund your business, does it take you away from your legitimate clients? Can it be, let me use the word distraction here, which Geeta doesn't want to?
No, that's a great question, sir. Thank you. So I think as I was listening to you all speak, I was trying to think, why is it that at RBIH we are not working more extensively with small finance banks? I think the reason is a very positive one, to be very honest. I'll come to your question in a minute, sir. Our conversations with private and public sector banks, we're always trying to convince them about why they should bank with unbanked. That is not even a discussion that we need to have with a small finance bank. Most of my work actually is involving convincing bankers that this process improvement is good, this product innovation is good, this segment is something that you should look at. I think with small finance banks, that was always a done deal. I mean, some of our conversations which we have had, we very quickly realized that you're already innovating a lot of the stuff that we are pushing banks to do, right? So I do believe that they have innovation in their DNA, and I do believe that the purpose of serving the unbanked customer is really truly served by this category of banks. Now, coming to your question, sir. Yes, I mean, I don't know about distraction or not. That's for the ecosystem to decide over time. Also believe we need to be kind to them. It's only been 10 years or less, since they've got these licenses. There's a very long shelf life to seeing the return on investments that they're making into the bank. Having said that, yes, it is a challenge for them to raise deposits. And in fact, this is one area where we are working with small finance banks, and we are in fact working with Suryodaya Small Finance Bank and partnering with a corporate BC to design a unique goal-based recurring deposit product to allow for them to collect deposits from the customers they are already serving. And it's a pity why they have not been able to tap into that market. I don't have an answer for why. That the woman that they're currently giving a group loan to or an individual loan to, why is it that they're not able to mobilize deposits from her, right? Because, sir, you and I know, everybody knows here, to this day, these women save. They save, albeit in very small quantities, in cash, in their homes, in their sari cupboards, in their rice jar or cookie jar, as the Westerners would call it. How can we mobilize that as deposits, for a small finance bank? To me, they are the most ripe clients to get that market share, right? So we are trying an experiment to build, to figure out what is the way to sustainably collect deposits in a cost-effective manner, which makes sense to the agent, to the woman, and to the bank. The verdict is still out there. I don't have an answer, how to make this economically viable. But I do believe that, them staying true to their DNA will involve them figuring out an answer to this. Yeah.
Okay, thank you for that. So when I come back to you, you are not let off easily with a good first answer. Now I think here is something I want you to deal with. When these banks were set up, RBI knew they are a special class of banks and they are going to do something that's having the pleasure and the burden of doing financial inclusion. Meaning customers, low ticket volume, whether it is deposits or advances. But then RBI also said that you people have to maintain a higher level of capital compared to normal universal banks. They said that, look, 50% of your loan should be really small ticket. And priority sector, you will do 75% of your, what do you call, net bank credit. And there are a few other things they said you should not do which the universal banks do, right? Now, how do you see this? Is it that the regulator is imposing some extra costs on you for wanting to serve the underserved, unserved? And how do these additional regulatory, what do you call, restrictions play out in terms of your ability to do business? Does it impact you in any way? And whether the costs, I think the part about technology also we should, you could be a small finance bank, but your technology should be just on par with, say, the HDFC, ICICI, or State Bank of India, right? So there are both investment and operational costs in that. So how does this impact you from the regulator's point of view, their expectation?
So I'll again begin with my one-line answer and then probably go on elaborating it. We see this as a test before the reward. Probably we work with the segment which is aspirational in nature. And, that somehow also seeped into our DNA, that we are also aspirational in nature. And if you are aspiring for something higher, let's say from being a MFI to NBFC MFI to a small finance bank, and let's say if we have our sites, or the most of the SFBs have their sites on the universal banking license, the journey has to be, it can't be that you come, you ask and you get it. You have to prove yourself, your worthiness, and since universal bank is a category, if there are certain privileges available, then there are costs attached to it. So are you up to that rigor? Before giving you that baton that you can also run a universal bank, do you have in it you? So that's one thing. Now coming to, as ma'am has rightly put that, there is definitely some pain points, in near to midterm. However, coming just one point, I think I agree with most of her observation, apart from one, or I would likely to differ with one point, that, this is not, I'll say, a distraction, the other things, because I do not think, or at least we as the bankers, we do not think that credit is the only requirement for this segment that we are serving or working with. So if we have the opportunity to give them an access to other financial services also, at least we do not think that it has been a distraction. It might be less rewarding than the credit that we are offering, but it definitely has a purpose to it. It makes my client more sticky to me, in difficult times, when probably the customer will, move away from institutions, we will find reasons to, make them stick with us. So that's why ma'am, with due respect, I disagree, or with that one observation. So that is the second part. Now coming to the bigger question, that if there is a cost attached to it, the compliances, which seems definitely onerous. Yes, there are costs attached to it, but at the same time, it prepares us for the bigger journey, for the higher journey. And I would also like to highlight here is that though regulators have given us the visibility on the universal banking license, and we know that probably if we are not right there as this point in time, but we could request that there could be interim measures as well. We understand that currently the CR requirements for us is equivalent to what NBFCs have, so that and then the universal banking requirement for them, the capital requirement is significantly lesser. There could be something in between as well. Once you achieve certain milestones, once you cross certain numbers, once you achieve certain kind of financial inclusion data, then we should have been given those measures. Apart from that, since we serve these segments which is definitely riskier than the segments probably the universal bank caters to, and we have been given that task, so we could have been also supported by easier and better refinances schemes, probably more credit guarantee schemes to cover a certain to cover those riskier segments, so that we continue our endeavor with same zeal or probably with increased zeal. So there are costs attached to it, and probably I think regulators can make it even better, and the test will probably continue, and we think we should be come up trumps.
Sorry, before you ask a question,
Oh,
maybe
yeah.
I
Yes.
will also clarify the distraction piece. Yeah, so I think for the lower income or the underserved, we are providing savings, insurance, housing finance, any other type of financial services. I would not say I'm calling that a distraction, but the point, I mean, you mentioned 275,000 crores of deposits raised. I would say 10% or less would be from. Okay. So, I mean, less than 10% of the 275,000 crore mobilized in deposit, maybe from our underserved segment. And you need to just go to a different segment and therefore adopt different techniques and tactics, which is where the distraction is. But I also wanted to address the point Shilpa made about, savings and because we've tried a lot in the past to make savings from underserved people just a more viable business, and on its own it's very, very hard. The quantums are small. I think with digital currency maybe it just becomes slightly better. I think it gives us more, but on its own the quantums, the frequency, the ease of withdrawal, because I mean, money in the house versus money in the bank is just it's different. And beyond a certain threshold, you really don't want them to save money in the bank account. We also don't, right? So I mean, there are higher interest products. So I do feel, I mean, I'm glad that you guys are taking up an exercise on that. It's an important product, but maybe if I can ask a question.
I'm happy to reduce my.
I mean, one question I would have is, I think you mentioned a significant majority or a majority of your loans are still from the microfinance space. I do feel that as MFIs have turned into SFBs, not all have the same proportion. There has been a shift, right or wrong. I mean, I think that's the bank's own call. But there also has been regulatory concern on unsecured lending and the growth of this, which again, if you go back to why they were set up and I mean, how do we keep the two things going on in terms of the mandate with which they were set up, the protection that we can give given the special mandate, and also with the protection, I guess the risk of unsecured slightly diminishes, but that's, yeah. So I don't know, any comments on S, yeah.
Okay.
I'm the only one who's listening.
So, couple of things. One is like when we have asked for this, I was talking about, sorry, you were talking about that only 10% roughly, the number which has been mobilized in savings from that target segment or from the rural poor masses. I agree. I am sure roughly the number would be the same. I have never said this on a platform, public platform, and this is something, and I'm not sure how. This is definitely not politically correct as well. But we treat ourselves as the crusaders, or the Robin Hoods, pooling the resources from people who have the disposal income, and disseminating that in the form of credit where it is needed. So it's not that how much we have mobilized as deposits from that strata, but it's more that there is an option available to that strata, that there is a bank nearby where they could save the money and forget about its security. That kind of assurance is there. So I'm saying just having this option as an option, that and when we highlighted that number of URCs, so when that assurance is there, that itself makes a difference to that category. It will always be like this, that the deposits mobilized from that strata will never be able to meet their own credit requirements. And that's why we are reaching to those geographies where we are primarily for mobilizing deposits. As you rightly said, that once we are in the bank, we have to raise our own funds and then disseminate it in the form of credit. But the idea has always been that once you have been assigned that tag of a bank, you will be able to demonstrate that kind of a ability to mobilize. You will be able to build that kind of a trust so that you can gain that kind of a deposits. So I think that's one part of it. Sorry, I missed this second one.
On whether all SFBs have that high percentage in the underserved sector.
Okay, so one answer could be, internally, even the strategic discussion that happens at our bank also, there is definitely a marked interest or strategy moving towards secured book, trying to bring the concentration of unsecured, or which is mostly the microfinance portfolio, as a percentage of the overall portfolio. But let me tell you something, while we are trying to bring up the ratio of the secured portfolio in our book, we never try to limit the growth of our microfinance portfolio. Since we have that is our legacy portfolio, that's almost in autopilot mode. We try to push the other verticals, the secured book, so that it can outpace the growth of our unsecured books. So net, what I'm saying is, let's say if my unsecured book is 10,000 crore this year, I'll always emphasize that it should never be less than 10,000 crore in the next year. It should be 10,000 crores, 500, 11,000 crore, even 11,500. But at a percentage of the overall portfolio, I want it to be reduced, so that if my microfinance or my unsecured book is growing by 20%, I would like my secured vertical to grow by 30%. It's also because, since, coming back to the question that, we have to mobilize deposits, so then we have to, display a certain kind of a strength. We are also, and quite a few of our, peers is now listed, and the books, numbers are, everything is in public. So, we have to also, demonstrate that kind of a strength. People understand, this strength comes from this secured book. So this entirely it's a part of the journey, and we are taking it up. Let's see how it goes.
Shilpa, before you respond to what Geeta asked, I have something else also to add for which you can. Do you also see, with the kind of a regulatory dispensation that is there, and the fact that these MFIs have become banks, is there adequate space for women being included, meaning as a special subset? The original microfinance, depending on the institution, anything from 100 to 70% were women clients. When you become a bank, gender is not the primary focus, you can't also. And you are diversifying business products, which means you bring several others in. So, as an outsider, how do you look at the inclusive part because of the upgradation of these institutions into banks and also the surrounding optics of the increased regulatory burdens on them? This is in addition to what Geeta asked.
Thank you. That's a great question. Just quick response to Geeta's question and on the savings piece that you spoke about. I always like to promote this product because I really truly believe in it and that it worked very well for that segment. The Pygmy Savings Scheme, which was active with one of the large public sector banks which got acquired by another one. I mean, it's a phenomenally useful product for that segment. I mean, my mom used it. One of my colleagues in RBIH used it until, that product was shut down till very recently. It's a very simple product. Someone comes to your house on a daily basis and collects a certain proportion of savings and deposits for you in the bank. Right? There's a very, very large book even to this day with one of the banks, right? I still believe that some version of that product can be revived for this segment. However, it would be really great if the ecosystem evolved in making it cheaper for the agent to go and collect that money and safer and cheaper for the agent and the customer. So I think there is scope for innovation there when it comes to mobilizing large swaths of deposits from women and from your customers. With respect to the unsecured lending piece that your question, sir, yes, that is a worry that I do have. That while it was 100% or 70, like you said, between 70 to 100% female customers, this 25% of non-PSL lending, which is actually the effort on their part, because the other part they always did, right, might sort of take away from that. And it's not easy to be financing women-owned enterprises. I mean, the number itself is so small. We were just discussing about this the other day. My wish there would be, and you can correct me if I'm wrong, I wish there was more innovation with graduating women customers from JLG into individual loans. Correct me if I'm wrong, I do not see too many SFBs having spent a lot of time and energy on doing that. I think the effort is in acquiring new customers, but you have a full gold mine of customers who very well, you've been transacting with you extremely regularly. Why can't we innovate in that 1 to 3 lakh range in the unsecured category? My worry with moving into this secured is that, that wasn't the purpose truly with which this, this institution setup was made. So it would be really nice to work on that innovation piece, to pull out women from groups and provide individual loans to them. Yeah.
Thank you. It's an interesting, you're echoing the same sentiment. Look, the expansion, looking at new types of clients is not at the cost of the original. There is going to be a growth rate there. It may not be as fast as the new one I am trying to grow because I have to catch up with all the regulatory needs. In a way, you are again echoing the same from a demand perspective. I'll just get back to you trying to connect your original observations in the first round. The regulatory issues. One of the examples is, look, you have a much higher capital adequacy requirement at 15%. When you look at the net NPAs, the comparative position today, at 0.78, probably they are much better than universal banks, high street banks. So this higher capital adequacy and incremental, they have to keep on doing it year after year. Does it not reduce their capacity to do business or increase the capital cost of doing incremental inclusion? How would you look at it? And
No, I mean, definitely the higher capital adequacy is a higher cost of, running the SFBs. And in fact, you had mentioned the NNPAs of SFBs and NBFCs in the beginning. I actually think the SFBs are just providing a lot more. So at a GNPL, I mean, from a pure underwriting perspective, especially for the microfinance segment, I doubt that SFB's performance is much superior than, say, the large NBFC. So, I would say, maybe marginally because of some tech innovation. So I would say portfolio quality underwriting with large NBFCs is similar. Coming to the banks, why the banks NPA may be higher than the SFBs. in some ways, it again goes back to 50-60% of them being microfinance, which has traditionally seen a lower NPA rate compared to individual loans or even larger business loans. The spread, how it gets just spread across, like the ticket sizes are so small. Although I think in the current scenarios, if you see microfinance is going through its own cycle. So my view is their GNPAs of SFBs will be higher than the universal banks. So yeah, I think the higher capital adequacy gives them a little more ability to take higher losses. But at the same time, I would say the underwriting methodologies they've developed, the smaller loan sizes that they have, even if it's graduating MFI customers, does give them an adequate cushion. So in some ways, even at a GNPA level, I doubt that a bank versus a SFB should be very different.
Any questions from the audience before I go to the last round of questions here to the panel? I don't see any hands going up. I think people are either too bored or too clear. I would choose the later as the conclusion. So now we have seen SFBs in existence for quite some time to be able to know what it does and what it can. What is your wish list by way of, say, incremental changes in policy, in regulation, in any other kind of external support to make the SFBs even more effective in their original mission? Yeah, go ahead, Nashima. Yes.
For me, I think, can we reimagine JLG in for this day and age? I would like to question some of the things that, which, probably made sense when it was being done 20, 30 years ago. But today, can we make it more digital? Can we reduce the burden of attending meetings for women, respect their time more? Can a lot of these things be done over video or, digitally rather than them having to come and meet together? Because, I've seen that stress on the field with customers with respect to, we don't want to do those weekly meetings. We don't want to do, we don't need to come together once a week, right? So can we reimagine JLG in today's world? And can we see more innovation in individual lending for your own JLG customers? I think those would be my two wishes.
You have a long list. Okay, no, I would say, I agree with what Shilpa said, but I still feel pure digital group loans very risky. So there has to be some touch point. Yeah, digital. But I think from a policy perspective, so I would say SFBs that are meeting the security, the tech and other requirements, opening up universal banking licenses to them should definitely be an option. And in that, then it's up to the bank on how much PSL they want to do, how much of the original. Like, we've created a market, you let them grow and let the free market decide where they are. But till a bank remains an SFB and has higher PSL and other requirements, my wish list is that, their cost of funds itself is easily 2% more than universal banks. So some support to enable them to, just be as commercially viable as the others, because they're playing in the same market as the banks when it comes to capital raise.
So I'll start with ma'am's observation or the wish list of that, we trying to graduate women borrowers into a more individual enterprise owning, enterprise running borrower. I think that, we have always been, or probably, there has been a distinction between SHG lending and JLG lending, where we have, approached this in a way that we will always be the credit provider. Let them be the best judge of using that. And only restriction, or probably only thing that we would like to, hammer on is the purpose has to be income generating. Please don't use it for the consumption purpose, as this is not a loan which you have to, this is not kind of a udhar, you have to return it with interest, and therefore this money must generate some return. So that's the one thing. And the what she is wishing, we also wish that, but we do not want to have a significant intervention in that. Let society take its own course, and these women borrowers who are as of now a group borrower, we would also like them to be enterprise running ladies, leading ladies. But as of now, probably it will take its own course. There are conversion, but significantly less than what we hoped for, what we wished for. But the idea is, let's provide them the right kind of ecosystem, the right kind of guidelines, policies, the right kind of incentives, so that they themselves come forward, graduate to the next level, and therefore we serve them. The other part is like from the regulation perspective, definitely the regulation, we are fine with those regulations, those stringent guidelines, those PSL requirements. But at the same time, there must be some rewards, some kind of a support as well. I already highlighted that the credit guarantee backing. Also, there could be some interim lowering of the capital adequacy requirement. Somehow we can also incentivize. I'm not sure what should be the exact way, exact measure to promote these women customers, these small customers who would like to have these small savings. How can we make their journey easy, make that saving a process more rewarding? Is there a way to give them slightly higher interest? I do not have the ready answer, but something can be think or discussed about these things. So the wish list is slightly, in my case, is slightly long, but I am ready to when you say that, and ma'am mentioned a couple of things about whether NBFCs, the quality of credit quality of NBFCs are any less than these SFBs. I also agree with her that that's not the case. It has largely been on the par. Someone significantly sized NBFCs versus we as SFBs. The quality of the assessment quality has been roughly the same. I think what probably served us better is the association of bank, so that we could offer more number of products, more number of services that can make the customer stick with us. And also probably sir mentioned it that it's not that, or in case of NNPA, it's not that our GNPA is exactly exactly that low, but in good times we have always made provision for these kind of stressful times. Like we always maintain a floating provision above than the required provision, the RBI mandated required provision, which is basically a safeguard for difficult times. The idea is to keep increasing it to a certain level of our so-called riskier segments, or you call unsecured segments, so that in difficult times, even sometimes I was talking to the other day that these days we talk about that as long as we stay sustainable, and this is probably the terminology of difficult times. In good times we used to say how can we increase our profitability, but all things put together, I think we have certain wish lists, and we are looking up to the regulators. Let's see how it pans out.
Thank you so much. Now there is a high table occupied by two veteran industry watchers there. I'm going to, since audience is not otherwise participating, I'm going to ask both of them to take 1 minute each and give their observations on where they think SFBs are. Tamalda?
Thanks, Srini sir. I'm not prepared for this, but yeah, I have been watching it. I think it's a very tough thing because the small sobriquet itself is a disadvantage for them, particularly for the when you look for deposits. So that's probably I would suggest that can they be recrystal like say development bank or those kind of stuff because small always hits you hard. You would not trust something small. So that's the main thing. And there two of the very challenging thing is one is of course the cost of compliance, they're not used to it, and second is the small thing. And I think almost all SFBs are running two banks under one roof. One is on the liability side, that's they are fighting with State Bank of India, HDFC, ICICI, Axis, Kotak, everybody else, so they had to pay much more. And other bank is for the credit side, which the so-called bottom of the pyramid on this thing. So I think it's a very, very complicated, complex animal. And again, almost all of them have the dream and ambition of becoming a universal bank. And as you discussed, their unsecured loan, they are a bit of scared of. He was talking very nice. In fact, I told Mr. Khan that Suman is making a lot of sense. But at the end of the day, hand on heart, in private, they are sick and tired of unsecured loan. They want to, whether they will officially admit or not, they said they want to do this. So then if that happens and they become universal bank and all, then actually have they served the purpose? I don't know. That question we need to answer.
You're putting very difficult time to me. No, I agree with most of the points made by the panelist. And Tamalda, I also thought that the tag of small can be possibly removed. I have a comment on that Robin Hood model. You said that we draw deposits from the urban areas, metros, and invest in rural area. But mind you, rural today is not what rural was yesterday. And agriculture is now less than 50% of rural GDP. And a host of other things are happening. And you must have seen all the studies and surveys. Farmer income from cultivation is only 1/3. 2/3 of the income of the host of other things. So the activity has expanded. So I think there are opportunities for deposit mobilization in rural areas. That is point one. Point two, the point of technology which Silpa brought. So sachetization with digitization is possible. So we had that earlier problem of cost of pygmy deposit because you had to send a physically one fellow. Then there is a risk of his running away with money, which happened with Syndicate Bank. You have not taken the name, I'm taking the name. Because that bank doesn't exist. So that can be handled through technology. So that sachetization of the digitization can happen. So when we talk about bottom of the pyramid, gold sitting, it is not only credit, it is deposit. Because the small customers make big market. And when you are now talking in the context of reduced CASA, that's a pressure everyone is facing. And you are telling that I should have more retail disaggregated deposit. It is there only there. They are very sticky. They are not going for 5-10 paisa. They are not shifting. They are not into internet banking. And the risk of suddenly withdrawing from internet and your bank collapsing because of liquidity, that risk is much less there, that Bharat segment, than India segment. So I think there are opportunities and there are now methods available. You need to work further on the methods to garner the deposits. The other point, I am not no longer a regulator. I am like most of our friends here, I look it from outside. I have some radical thinking when I was just hearing about that. We have all along talked about priority sector lending. Why not talk about priority sector deposits? If you take deposits from XYZ area, URCs, if you are taking deposit, you do some reduction of CRR, SLR in that area. Okay, so that you can give, and your chachas and bhatijas of cities will not come and use as mule account because you are going to reduce the rate of interest because you got a benefit of CRR SLR. So your rate is not high, but you can gather deposits there because the cost still feet on the street is still there. So I think that possibly you can, now that my younger colleague is there from Reserve Bank, maybe you can do some manthan on this. Is there any scope for priority sector deposit from those segments? Because, but remember, savings is the mother of all financial services. So if you start saving, building your credit history with savings, I think you can build quite a few products. I think credit is important, but then, so this is what I thought I'll make these two comments. But the final comment I will make is that, in a sense, SFBs are RRBs in a private sector. Okay. If there are RRBs in private sector, the mandate is fine and mandate has no problem. As you said, they're all selling PSL. So 75% is not an issue for them. This question is, how do you come with innovative products so that we have all gone beyond that phase? So a lot of new things are happening, whether you are in a position to catch this new product innovation. And for the rural areas, we have done quite a few things in case of credit, but in case of liability still product, I think you are talking about some product you are trying to do. I think liability side also you need to innovate some products. I think that is what I thought. But one important thing, I just final point I want to say. For the small finance bank, they're in a big way into technology and digital. But as I mentioned yesterday, educate customers in an intense manner about how do they protect themselves from the frauds. Because you and I losing 1,000 rupees, 2,000 rupees is not important. A rural folk, first generation to bank, loses 1,000, 2,000 because of this fraud. He loses entire trust in the system and he goes away to the old bank informal system. So I think that's one part, maybe as an association, we should work on that. Thank you.
Thank you, Kansab, and thank you, Tamalda. You concluded our session brilliantly by putting a cap on the discussions. There was one more question which I was about to broach with the panel. I am not broaching it. Is it that the SFBs will finally get their salvation by becoming universal banks? But then, the salvation for the customer that they are focused on, I think that's also equally important. Yesterday, I think Mr. Vaidyanathan in the inaugural session, he talked about how, despite being a universal bank, their focus is on the customers who are at the bottom of the pyramid or at the middle of the pyramid. Meaning, eventually, high street clients, there is a limit. So, where the banks can expand. The battle for CASA from the URCs, so to say, it's universal. It is not just small or loan. So, that shows that the clients are going to be better served since competition kicks in and the banking space is getting crowded. I think the last point, remember, based on what Khan said, poor people need not necessarily be served by poor institutions. They also require the best-in-class institutions so that they enjoy good services. And eventually, the cost to the economy is lower, despite costs temporarily being higher for customers. So, whether they have to have the best in technology. But then, I would personally feel the distinction in terms of regulatory restrictions between the small and the universal should be proportionate. Some parts of it I see today as being slightly disproportionate. If the regulator could work on those and then level that playing field, then maybe the CASA will probably be the same CASA at the same rates for all, not necessarily 2-3 percentage points higher at the small finance bank and lower elsewhere. So, and thank you all for your patience and giving a good listening to us. Thank you, excellent panel. You reduce my load.
Thank you. Thank you thank you to all the panelists for such an enriching discussion. And thank you, Mr. Srinivasan, for this engaging and dynamic moderation. We have a very small token of appreciation. Team, please present that. And then we will have a group photograph. Thank you all the delegates for joining us in this session. We'll have a very interesting session just next to this. That is on microfinance and empowerment in India, and that too, again, taking the village level studies perspectives. So please join us in that session. We'll be starting that session shortly. Thank you.